So guys, in this video we are talking about basics of technical analysis, and let's see what we have next. So first one is introduction to charting and trading. There are different type of charts, for example line chart, bar chart and candlestick charts, and then there will be a different type of bars. So now let's move toward our trading view, and here if you click here on bars, then you can see here line with markers, step lines and all other stuffs. And Heikin-Ashi bars I usually use, and here you can use any candlestick pattern, like here, like these hollow candles and volume candles. Okay, Heikin-Ashi is available downside, so it totally depended on you which chart you seem very familiar, and because each strategy can be different according to different bars, as we have seen previously that our strategy was not good in these candles, but when we try to apply it on Heikin-Ashi, then our win rate was drastically increased. Okay, so now let's move toward identifying market trends. I already explained that this first two sections are for the beginners and introductory peoples, so if you are familiar with these things, you can easily move toward our advanced sections, which is section 3. So first one is uptrend in the bullish market. So if market is continuously breaking the previous structures, and if market is continuously going upside, and that whole market will be considered as a bullish market. So usually you should try to go with the bullish side when there is a uptrend, and when there is a downtrend, bearish market is continuously going down, so you should try to go with this downside moves or downside trades. Why? Because these are considered as a trend friendly strategies, and if you are going with the trends, then those have very high win rate, and when those high win rate will come, definitely you will earn a lot. But when you will try to do reversal trading, that's the psychology of most of the traders. Like if market is going down, so they will think that it's already gone very up, and market will go down here, market will go down here, and market will go down here. This is the strategy, or this is the psychology of most of the traders, and that's absolutely wrong. Always this is considered as a reversal strategy, so I don't recommend reversal strategy, because reversal strategies have very low win rate, and always try to go with the trend. So how to confirm trend? There are multiple ways, like trend lines. First of all, draw along higher lows and uptrend, and higher highs in the downtrend. For example, here you will draw along higher lows like this one. This will be a trend line, and for the downside, like this, you can connect both ups and lows of both, and that will be considered as a trend. You can also use moving average of 50 and 200. I also use is 50 moving average for determining trend, because going with the trend is very necessary, and then 200-day moving averages to help smooth price fluctuations. Volume confirmations are very necessary, and we have a whole course related to this volumes, which is considered as a wake off volume. So its price is pretty much high, and because it's the method of institutions, and most of the people and most of the institutions, most of the hedge funds uses these volume confirmations and volume strategies to go in one specific direction. So that's why that method has very high win rate. So third one is recognizing key chart patterns. So if you are not familiar with head and shoulders, double tops, double bottoms, flags, peanuts and these triangles, so you should join our course, which is a chart patterns course, powerful chart patterns course. And if you are still know these things, then again you can join that course. Why? Because we are not only analyzing those charts patterns, but we are also combining it with the volume spread analysis. So those two things are related to each other, and when you will combine volumes, or when you will apply volume spread analysis in between these head and shoulder patterns or in all these patterns, then your accuracy will be highly increased. Okay, So these are the continuation patterns. Continuations patterns simply mean that, for example, market is going up, and if it forms these type of patterns, then these patterns will be considered as a continuation pattern, which means that market is again going in the same direction. Reversal patterns, for example, head and shoulder pattern is a reversal strategy. For example, market is going up. If this pattern forms as up of the market, then there are chances that after the breakout of this neckline, market is going down. There are multiple technical indicators for data analysis. Because why we are understanding it, or why we are considering it, because if you are seeing head and shoulder patterns, because I already mentioned that little bit human intervention in between those expert advisors is very necessary. So whenever you are seeing these patterns in the 1 hour and 4 hour, or whenever you are seeing these moving averages, and whenever you are seeing some RSI divergences and all other stuffs, so you can easily combine it with your expert advisor. And if you are seeing this, you can easily go with one specific side. You can off one specific buy or sell bot, and you can enable another bot. So in this way, if market has needed to go down, then of course you will get a lot of profits. So running a bot on both sides is not that much good. Why? Because if market is bearish and you are running both bots, so of course if you are running it in the 5 minute or 15 minute, there will be noises, there will be retests, so your stop loss is going to be hit most of the time. Of course its win rate will be good, of course its profit will be good, but the profit will not that much. By intervention your own analysis, by seeing and understanding these analysis, you can easily enable, or you can easily enhance its win rate. Now let's talk about technical indicators for data analysis. So first one is moving averages. These are simple moving averages and exponential moving averages. These two plays an important role, and you can easily determine trend in one specific site. Here I use 50 moving average, and you can see how much it is working. So whenever market tested this EMA, and market suddenly moves downside because previously market break down, and here again same scenarios happen, market suddenly moves downside. So that's the power of this SMA. And if you wanted to combine it with 250, and that will give you best results. Usually 50 and 200 EMA gives us the golden ratio or death ratio. Golden ratio simply means that, or golden cross means that when those 50 will cross 200 and market will go up, and that is considered as a golden cross. And market usually goes upside, that is considered as a bullish scenario, and opposite is bearish. So next one is relative strength index, RSI. It usually measures our bought and our sold levels, and if you are familiar with it, then you don't need to trade with the our sold and our bought levels. I will add one more video related to divergences. So usually RSI divergence strategy works very well. And then MACD, moving average convergence divergence, like it usually helps you to confirm trend direction and momentum. The same scenario is Bollinger Bands and volume indicators. If these are not necessary in this course, and still if you need it, we will try to add this also in this whole course. Okay, so hope you know get understood for basic chart readings and trends and patterns and all other stuffs. So why we are understanding it, or why these are very necessary, because we will try to build one expert advisor with this whole course. And of course it will have, maybe it have less win rate, maybe it have high win rate and all other stuffs. So first of all, my best recommendation is try to do 100% without human intervention bot that has good win rate with 1:3 to reward ratio. So if you're successful with it, that's perfectly fine. But if you are if you have own strategy, and if you wanted to get your EA related to that strategy, so you can easily go with that by understanding these things and how these things works, and then you can apply it by doing drop and drag things. Okay, so now let's move toward our next video. In this video we are talking about introduction to technical and fundamental analysis. So previously I have given you all the basic tools for technical analysis, and hope you are familiar with the market structure and what are the basics of market structure and how choke and break of structure and all those things works. So here a little bit basics related to technical, like market prices reflect everything, like all fundamental and external factors are already accounted for the price. So market usually works both for the fundamentals and technicals. So why we are understanding it and why we will consider fundamentals, because when there is different times for your expert advisors. For example, if your EA is not going very good, and if its win rate is good, but you usually hit stop losses at the time of news due to wide spread. So to stay away from those things, we will try to optimize our EA with those things like news filtering and all other stuffs, because whenever fundamental events will happen, whenever news will come, then there will be a lot of spreads and stop hunts. So that's why we will have to embed those external factors. These three are the basics, like price moves in trends, whatever a bullish trend, bearish trend, and sideways, and then history repeats itself. Traders react similarly to market conditions. You create repetitive price movements, but these are not 100% true, because history, of course, history repeats, but it's 50 to 70%. History does not repeat all the time. Key tools in technical analysis are charts, like I already explained you about those charts, and then indicators, I already given you, and chart patterns and support and resistance levels. So what are the best recommendations for manual trading? If you are applying manual trades, or if you are using my own code for manual trading, then I will recommend use it in the 15 minute, because that's will considered as a day trading or swing trading. I don't recommend scalping, because scalping usually disturbs any trader psychology. So usually people try to do scalping on 1 minute or 5 minute, but that's totally a waste of energy, waste of money, and of course there will be a lot of noise in low time frames. So it's very difficult to go with the scalping thing, but going with the swing trades, intraday trades, and based on the verifications of higher time frames, that's highly recommended. Fundamental analysis, these are core components like macroeconomic factors, and then company financials, industry sectors, and news and events, and all these stuffs. So why these are important? These usually responsible uh, for one specific trend. How you must follow some strong fundamental analysis person on YouTube, and whichever side he predicts, you should try to go with those sides for the longer terms. What is the best example? Here if you see my trades, these are the best examples of these fundamental trades or fundamental analysis. Here if you see all my trades, and when I have taken these trades. So this is the best example for fundamental, strong fundamental analysis, and then combining those fundamentals with the technicals, and you will earn a lot. Okay, so how I have achieved these type of results? Usually I close half trades, and then I will keep other trades, and I know that fundamental analysis are very strong and market is in the uptrend. So this is the power of trend, and going with trend is highly recommended. This is the one simple sell trade, but that sell trade is maybe going to hit break even at this point, because overall trend is bullish. Okay, so now let's move toward the technical and fundamental, which are the best. You will have to combine it both. For trend analysis, for direction, you will look for fundamentals, and technical will give you exact pinpoint or exact entry criteria. These are the simple things that how they can influence our trading strategies, because we are implementing trading strategies on expert advisors, and if we do not understand these economic factors, of course our strategies will not go longer. I am breaking the thinking of most of the people, that they will think that some people or someone will come and they will get some code, and that code will build billions for them. That's not true, because each person will have own strategy. Each person must understand each and everything, and then you should move. Going blindly and going without knowledge, of course you will burn out your accounts. So this is the first example, like technical analysis viewer. Our trader uses or sees a strong support level at here and potential breakout above. And then what will be the fundamental analysis? The European Central Bank ECB is expected to raise interest rates, potentially strengthening the euro. So if euro is going to be strengthened, then of course that support level is going to be worked out properly. Should you use technical for fundamental analysis? Here are the simple examples. If you are a trader, you should use technical, and if you are an investor, you should use fundamental analysis. We will try to combine these two things in our expert advisor so we can get better accuracy. But after completing this whole course, I will guarantee you that you can work on any strategy with the automation basis, because there are a lot of ways for automation, and you can easily go with that. In this video we are talking very important factor. Whatever you are doing manual trading, or whatever you are doing automation or expert advisors and all other stuffs, this is a very important. And if we see about a human mind or a human psychology, then most of our traders don't put stop losses, and that's the main reason that their account usually got washed. So there is multiple approaches. Maybe if you put one to two trades SL, then third trade you will not put SL, and same scenario whenever you will lose these 2 to 3 trades with the SL, then you decided you should not go with the SL, and maybe you think that market is again going in your favor, but those things are totally wrong. You should always put a strict SL, and if you are not winning in one specific day, you should move into another day and then another day. But you should always put a SL and do a strong risk to reward ratios, and strong risk management is required. So why risk management is important? So every trader loses, and most of the professional traders also have strong risk management, and risks effectively should be managed to overcome your all those things which can place a great hurdle in your success. So our first one is our leverage their positions. If your account is not that much, and then don't try to open a lot of positions. What the people do most of the time, if they have $100 account, then they will try to open 0.30 or 0.20 lots. So that's almost risking your 70% or 50% account. That's totally not recommended. Always try to follow some strong risk management, strong risk to reward ratios, and then after going with those things, you can be successful. Why those things are necessary? Because if you hit stop loss one time or two times, then your whole account is going to be broke. Why you will hit stop losses? Because there is not any strategy who gives you 100% results, or who haven't it up to 100%. There is not anything which exists. So each person will hit stop losses. My own stop losses always hit, and all professional traders hit their stop losses. Okay, so that's why risk management is very necessary. These are the simple key management rules, like 1 to 2% rule, limiting risk per trade. This is a simple example. If your account is $100, then don't risk 1 to 2% like $1 or $2. For example, if your account is $1,000, then you should not risk more than $10 or $20. How and why this works? Because if you lose, you will only lose $10 or $20, but when you will get reward, you can easily get up to $30 or $50. This is the simple 1:3 risk to reward ratio, and same thing we will try to apply it in our expert advisor. Okay, so how you can calculate your lot sizes? This is a simple formula you can use. Same scenarios should be there in crypto, same scenario should be there in the forex. I have seen thousands of crypto traders, and they don't use any SL, and they will think that market will go in their favor, but those things does not happen. That's why these things are very necessary, because This is the human psychology. People cannot afford to lose. So if you do not afford to lose, you do not deserve profits. Just cutting your losses, and if you have a courage, hold your trades in profit like me, but don't hold your trades in the losses. Just cut your losses and escape away from the market. These are the simple strategies like take profit and stop loss strategies. These things are well explained in our all other courses, but in this course we will try to go with fixed stop losses and fixed take profits with the proper risk to reward ratios. Okay, so these are the simple our trading and psychological pitfalls, like common psychological traps. First one is revenge trading, when you will hit one stop loss or two stop loss. Third trade you will enter, then in fifth trade you will enter, or fourth trade you will enter, and of course most of the trader don't use SL. That's called a revenge trading, and that revenge trading will blow your account. And then there is greed, like if you think your setup is going to be work out like 80% or 90%, and if you are getting the confirmations, then that does not mean you are getting the confirmations or you have 100% accuracy, or you are 100% sure about one setup. You should go more. You don't need it to go more with that. You just needed to stay with your plan, or you just needed to stay with your overall trading. Don't try to go more as you usually do. Fear is another important factor, and when you will see some profits after going into any trade, then most of the time people cannot hold profits, and they will think that that profit will be gone forever, and they will just exit from the market. So those things should be tackled. And if you see my trades, my all trades are in profit, and I am not getting in fear. If market suddenly goes down, and if market hit all my stop losses or all my break even, that does not matter to me, because my original portfolio was $5,000, and I am up already $600,000 or $7,000. So it's absolutely fine for me. So these type of mental psychology can be able to hold your trades for the longer term. And then emotional bias, like ignoring trade setups due to past experiences. These are another thing, like if you win two or three trades and most people think that again they will lose and they will not enter, and they don't have a courage to enter in the market. So those things should also be tackled, and always work on systematic way, or always work on strong strategy, whatever you are doing, manual trading or whatever you are doing, expert advisors or all other stuffs. Then managing risk in different conditions, like you can what approaches I use. If I check that my accuracies or my surety about one setup is about 30% or 50%, then I choose lots according to that. That's a very good strategy. Also, if you have a one SL, then you can buy in pots, because market usually retest. And if you have put stick stop loss once for one specific trade, you can limit, and you can put in parts. In this way your loss can be average. This is a simple example, like this is a morning star, and usually market retest up to this much. Okay, so when market is ahead here, you can buy off, you can buy off, you can buy off, you can buy off. So whenever if market hits your stop loss, your loss will be averaged. Okay, don't try to go blindly at this point. So these are the simple final thoughts, like always protect your capital, and your first goal is to survival, second goal is profit. So if you are surviving in the market for 6 months or 5 months, then you are a successful trader. But if you are not losing, and if you are not getting profits, you are 100% going good. But if you are consistently losing and not making profits, of course you will not stay longer. So staying longer in the market is very necessary. Most of the people just put their money, and then they will blow that money after 1 month, or maybe after 15 days or 15 days, by going into greedy situations. Okay, always use stick risk to reward ratio. But if you see my trades, I already booked profits, half profits, so I already manage those risk to reward ratios, and I'm holding for longer term due to fundamental analysis and due to the bullish trend of the gold. And then avoid mental trading, like discipline and consistency are key. And if you are properly consistent for the longer term, of course you will build profits for the long time. Always target for the monthly basis or weekly basis. So if your weekly basis targets are hit for after 1 or 2 days or 3 days, then don't take any trade in one specific week, and then you can move into the next day. You can move into another week. Same scenario is if your target is 5% to 10% in one specific month, and after hitting that, don't trade any more in that month, and you can move into another month. Don't get greedy. You're not going to become a millionaire. Always look on these trading things according to your businesses, and businesses, you cannot become a millionaire in 1 or 2 days or 1 month, after 1 month or 2 months. And don't expect these things from trading. Always go with the systematic way. Okay, so hope this all video and all section is well clear.